How does AML compliance use CTF in crypto? Imagine trying to catch someone sneaking around with hidden money. That's what anti-money laundering and counter-terrorist financing efforts aim to do in the world of cryptocurrencies. When dealing with crypto exchanges, authorities and companies work together to stop illegal activities like funding terrorism or hiding illicit gains. Anti-money laundering compliance involves verifying who customers are through Know Your Customer procedures. This means exchanges ask for identification documents, like passports or driver's licenses, to confirm identities. They also monitor transactions for suspicious activity, such as large transfers to high-risk countries or unusual trading patterns. These steps help prevent criminals from using crypto to hide or move money illegally. Counter-terrorist financing, or CTF, is a part of this process. It focuses on stopping funds from reaching terrorist groups. To do this, exchanges screen transactions against lists of known terrorists or sanctioned entities. If a transaction involves an address or person on these lists, it gets flagged or blocked. This is essential because terrorists often rely on crypto to move money quickly and secretly. One key rule that helps in this effort is the Financial Action Task Force Travel Rule. It requires virtual asset service providers, like crypto exchanges, to share customer information when transferring large amounts of crypto. This makes it harder for bad actors to hide their identities or hide where the money is coming from. Crypto exchanges also use transaction monitoring software. This software looks for patterns that might suggest terrorist financing, such as transfers to or from countries with high risks or addresses linked to illegal activities. When suspicious activity is detected, authorities can investigate further. Maintaining records of customer details and transaction histories is another important part. These records support investigations and help regulators ensure compliance. If authorities find a link to terrorism or money laundering, they can trace the flow of funds back to the source. Centralized exchanges, which act as middlemen, usually enforce these rules more easily. They charge fees for transactions and have various order types like market or limit orders. They also control user access through compliance checks, making it easier to prevent illegal activity. Decentralized exchanges, on the other hand, operate without a central authority. They often have lower fees and fewer order options, but face more challenges in enforcing AML and CTF rules. Some decentralized platforms are starting to adopt compliance tools or partner with third-party services to improve transparency. In summary, AML compliance uses CTF by verifying identities, monitoring transactions, sharing information, and reporting suspicious activity. Centralized exchanges can implement these measures directly, while decentralized ones are gradually adopting solutions to address the risks. This combined effort helps keep the crypto space safer and less attractive for illegal activities.